Dave made a smart decision. At least, that's what he told himself on the drive home from the dealership. No sports car, no luxury badge, just a sensible, practical, moderately priced mid-size sedan. The kind of car a responsible adult buys. He even negotiated. Got them down $400 off the sticker. Felt pretty good about that. 3 years later, Dave is sitting in a parking lot outside a grocery store. He's been sitting there for about 20 minutes. He can't go inside yet because he just did the math. For the first time, actually did the math on what that sensible, responsible, moderately priced car has cost him. And the number is still loading in his brain. Welcome to Dollar Blind. And today we're talking about the real cost of owning a car in America. Not the sticker price, not the monthly payment, not even the insurance bill you wince at every 6 months. We're talking about the full number. The one the dealership never put on the windshield. The one most Americans will never calculate because the system is specifically designed to make sure they don't. By the time we get to the opportunity cost section, you're going to want to pull over. Section 1. The number. Everyone knows and nobody actually knows. Let's start with what you think you know. The average new car price in America right now sits just above $48,000. Let that land for a second. $48,000, that's the average, not the luxury average. The average. A few years ago, it was closer to $36,000. Before that, closer to $28,000. The car you're driving, or the car you're thinking about buying, costs more than it has ever cost in American history in nominal dollars by a significant margin. But here's the thing. Most people don't actually feel that number because most people don't pay that number. They pay a monthly payment. And monthly payments are one of the most effective financial illusions ever invented. Think about how a car purchase actually works in practice. You walk onto a lot. A salesperson asks you one question. Not what's your budget, but what's your monthly payment? And suddenly, the entire negotiation isn't about the price of the car. It's about a number small enough to feel manageable. $300 a month sounds reasonable. $400 sounds fine. Even $500? It's a car. You need it. What are you going to do? What they don't emphasize is everything that sits behind that monthly number. The term length, the interest rate, the total paid at the end of 60 or 72 or now increasingly 84 months. 7 years of payments for a vehicle that started depreciating before you even got it home. And the term creep is real. In 2010, the average auto loan term was about 60 months. Today, nearly a third of all new car loans are for 73 months or longer. Some lenders are now offering 96-month terms, 8 years, on new vehicles, which means people are making car payments on vehicles that will likely need major repairs before those payments are even done. The loan outlives the useful life of the car, and that is a feature, not a bug, for the people selling you the loan. Because here's what a longer term really means. Lower monthly payment, same or higher total cost, and a much longer window where you're underwater on the vehicle and can't escape it without losing money. It's a trap with comfortable feeling walls, and we haven't even started on the actual cost yet. That was just the purchase structure. Section 2, the depreciation trap. Your car lost value on the drive home. I don't mean eventually. I don't mean over time. I mean on the specific drive from the dealership to your house, your car, the one you just negotiated so hard for, the one you got $400 off the sticker on, was already worth measurably less than what you paid. Here's how depreciation actually works. The average new car loses somewhere between 9 and 11% of its value the moment it's purchased. Not over the first year, the moment it's purchased. It crosses from new to used the second you take possession, and the market reprices it accordingly. In the first year of ownership, the total depreciation jumps to around 20%. By year 3, you're typically looking at 40% gone. By year 5, most vehicles have lost somewhere between 45 and 60% of their original value. So let's run that on a real number. You buy a $45,000 car, slightly below average, you're being responsible. Day 1. The car is worth roughly $40,000. You've absorbed $5,000 in losses simply by owning it. By the end of year 1, that car is worth somewhere around $36,000. By year 3, around $27,000. You've paid 36 months of loan payments, and the car is worth less than 40% of what you financed. This is called being underwater. And tens of millions of Americans are underwater on their vehicles right now, at this moment, without knowing it. Here's where it compounds. Dave, remember Dave still processing in that parking lot? Dave actually bought a 3-year-old car. Smart move, right? Skip the steepest part of the curve. And that logic is correct as far as it goes. But Dave financed his used car. And here's what Dave didn't know. The interest rate on a used car loan is meaningfully higher than on a new car loan. In recent years, the average used car loan rate has been running roughly 2 to 3 percentage points above new car rates. So Dave outsmarted the depreciation curve and walked directly into a higher financing cost. The system accounted for people like Dave, it always does, and depreciation doesn't stop at year 5, it just slows down. The car that cost you $45,000 is worth maybe $12,000 to $15,000 at year 10 if you've kept it up. You paid $45,000. You paid interest on top of that. You paid to insure and maintain it for a decade, and now it's worth $15,000. That is the actual math of car ownership in America. Section 3, the loan structure. Nobody explains. Here is something your dealership's finance manager understands completely and almost certainly did not walk you through. Auto loans are front-loaded. What that means is this. In an amortized loan, which is what a standard auto loan is, your early payments are weighted heavily toward interest. The principal, the actual amount you owe on the car, barely moves in the first year or two. You are servicing the lender's return first and your own debt second. Let's make this concrete. Say you borrow $35,000 for a car at 7% interest, which is approximately where average used car loan rates have been running. 60-month term, your monthly payment lands around $690. Over the life of that loan, you'll pay approximately $41,400 total. $6,400 in pure interest on top of the $35,000 you borrowed. But here's the part that actually stings. In month 1 of that loan, about $204 of your $690 payment goes to interest. Only around $486 reduces your principal. By month 6, you've handed the lender over $4,000 and your loan balance has dropped by approximately $2,800. The other $1,200 went straight to interest. That money is gone. It didn't reduce what you owe. It didn't build equity. It compensated the lender for the privilege of lending you money to buy a depreciating asset. Now layer that against depreciation. In that same first year, your car dropped in value by 20%. Your loan balance dropped by much less. That gap between what the car is worth and what you owe is the underwater zone. And the larger your loan, the longer your term, and the steeper the depreciation on your vehicle, the deeper that gap gets. Here's how people get trapped in this gap. They get 2 years into a loan and want to trade up. The dealer runs the numbers. Turns out the car is worth $4,000 less than the payoff amount. The dealer offers to take care of it by rolling that negative equity into the new loan. So now you're financing a new car plus the remaining debt from your last one. Your payment goes up slightly, not alarmingly, and you drive off in something newer, feeling like you handled it. What you actually did is dig the hole deeper and reset the amortization clock, which means you're right back at the front of a new loan, paying mostly interest again, on a balance that was already inflated by old debt. This cycle is sometimes called the car payment trap. Financial researchers have documented it extensively. It's one of the primary mechanisms by which otherwise financially stable Americans bleed wealth invisibly over their working lives. Not in one dramatic moment, just slowly, predictably, at $690 a month. And the loan structure isn't the last hidden cost, not even close. Section 4, the costs that never stop. Okay, so we've got purchase price, depreciation, and loan interest. Dave is still in the parking lot. Let's keep going, because we haven't even touched the costs that just keep arriving every single month, whether you drive the car or not. Auto insurance. The average American pays somewhere around $2,100 per year for auto insurance. That is the national average. Averages there have exceeded $4,000 annually for a single vehicle. New York, Florida, and Louisiana aren't far behind. Some urban drivers are paying $500 a month just to stay legal in their car. That's $6,000 a year on top of everything else. And insurance isn't static, it adjusts. Your premium goes up after an accident, even one that wasn't your fault. It can go up when your credit score drops. It goes up when your insurer has a bad year and passes costs to policyholders. It goes up seemingly at random and with minimal explanation. The average American's auto insurance premium has been rising faster than general inflation for most of the past decade. You bought the car once. In those states, the government charges you for the privilege of owning it annually, based on what it's worth. If you own a newer, more valuable car, your annual tax bill reflects that. Maintenance and scheduled service. The manufacturer's recommended maintenance schedule on most modern vehicles runs somewhere between $500 and $900 per year. You bought the car once. In those states, the government charges you for the privilege of owning it annually, based on what it's worth. If you own a newer, more valuable car, your annual tax bill reflects that. Maintenance and scheduled service. The manufacturer's recommended maintenance schedule on most modern vehicles runs somewhere between $500 and $900 per year. You bought the car once. In those states, the government charges you for the privilege of owning it annually, based on what it's worth. If you own a newer, more valuable car, your annual tax bill reflects that. Maintenance and scheduled service. The manufacturer's recommended maintenance schedule on most modern vehicles runs somewhere between $500 and $900 per year. That's if nothing goes wrong. That's the routine cost of keeping the car in the condition the manufacturer requires to honor your warranty. Things go wrong. The average unexpected car repair in America costs between $500 and $600 per incident. Brake jobs run $300 to $800 depending on vehicle and severity. Tires, a full set of 4 on a mid-size vehicle, run between $400 and $900, and most cars need new tires every 4 to 6 years. Transmission work can run $1,500 to $4,000. An alternator replacement, $300 to $800. Water pump, $400 to $900. If you own a car long enough, you will encounter most of these. And now the car has generated consumer debt in addition to auto debt. Fuel. The average American drives roughly 15,000 miles per year. Depending on your vehicle's fuel economy and where you live, that's somewhere between $1,800 and $2,800 in gasoline annually. Drivers of trucks, SUVs, and older vehicles sit at the higher end. If you're paying $200 a month in parking, that's $2,400 per year on top of everything else, just to store the car while you work. Now, let's put these together into a single annual number, and I want you to do this with your own car while we go through it. Insurance, $2,100. Registration and taxes, $250. If you're paying $200 a month in parking, that's $2,400 per year on top of everything else, just to store the car while you work. Now, let's put these together into a single annual number, and I want you to do this with your own car while we go through it. Insurance, $2,100. Registration and taxes, $250. If you're paying $200 a month in parking, that's $2,400 per year on top of everything else, just to store the car while you work. Now, let's put these together into a single annual number, and I want you to do this with your own car while we go through it. Insurance, $2,100. Registration and taxes, $250. Scheduled maintenance, $700. Unexpected repairs averaged annually, $400. Fuel, $2,200. Parking, $0. We'll leave this out. That's $5,650 per year just to operate a car you already own. before $1 of loan payment, before any depreciation, just the cost of keeping it running. Dave had never put those numbers in one place before. He'd processed each one individually, but he'd never written them on one line and looked at the total. $5,650 per year. For a car he also has a payment on. For a car that is losing value while he makes that payment. That's when Dave needed the parking lot. It's the money you could have had. Opportunity cost is the financial concept that says every dollar you spend on one thing is simultaneously a dollar you chose not to spend on something else. When you're talking about $10,000 or $12,000 a year, which is where the average American's total vehicle costs land, the opportunity cost is enormous. Let's use $10,000 as our conservative baseline. One vehicle, $10,000 per year in total ownership costs. Now, let's ask a different question. What if, instead of directing $10,000 a year toward a vehicle, you redirected it into a broad market index fund earning an average annual return of 8%? After 10 years, you have approximately $144,000. What if, instead of directing $10,000 a year toward a vehicle, you redirected it into a broad market index fund earning an average annual return of 8%? After 10 years, you have approximately $144,000. After 20 years, that becomes roughly $460,000. After 30 years, which is well within the investing horizon of someone in their 30s or 40s watching this, you are sitting on approximately $1,100,000 from one car, not from eliminating the car entirely, from one car's worth of annual costs redirected. Let's use $10,000 as our conservative baseline. One vehicle, $10,000 per year in total ownership costs. Now, let's ask a different question. What if, instead of directing $10,000 a year toward a vehicle, you redirected it into a broad market index fund earning an average annual return of 8%? After 10 years, you have approximately $144,000. After 20 years, that becomes roughly $460,000. After 30 years, which is well within the investing horizon of someone in their 30s or 40s watching this, you are sitting on approximately $1,100,000 from one car, not from eliminating the car entirely, from one car's worth of annual costs redirected. What I am telling you is this. There is a version of car ownership that costs your household $7,000 or $8,000 a year, and there is a version that costs $12,000 or $15,000. The difference between those versions, managed intelligently over 30 years, is the difference between a retirement account that works and one that doesn't. Most people have never calculated which version they're in. What I am telling you is this. There is a version of car ownership that costs your household $7,000 or $8,000 a year, and there is a version that costs $12,000 or $15,000. The difference between those versions, managed intelligently over 30 years, is the difference between a retirement account that works and one that doesn't. Most people have never calculated which version they're in. Section 6. Why the true cost is deliberately hidden. Let me be direct about something for a minute. The automotive industry, manufacturers, dealerships, lenders, insurers, and the broader ecosystem is a multi-trillion-dollar machine. And that machine is specifically optimized to prevent you from thinking about total cost of ownership. Because if you thought about total cost of ownership clearly, completely, before you signed anything, you would buy differently. You would buy less expensive, you would buy less often, you would hold your vehicles longer, and that would be very bad for the machine. So the machine makes it hard. The monthly payment frame isn't accidental. Dealers have understood for decades that consumers anchor on monthly payment rather than total price. This is documented in sales training materials. It's a core tactic. Get you nodding at a monthly number that feels manageable, and you've essentially agreed to whatever the total comes out to because you're no longer negotiating on total, you're negotiating on monthly. And when you negotiate on monthly, the dealer has enormous flexibility. Extend the term, adjust the rate slightly, bundle in add-ons, and the monthly payment barely moves while the total cost climbs significantly. The complexity of the paperwork isn't accidental either. Auto loan contracts are dense, the interest structure isn't visualized. The total amount paid over the loan term is disclosed, but it's buried in a block of text. Most people do not calculate the total interest on their car loan before they sign. Most people have never done it after. The dealership finance office is one of the most profitable parts of any dealership's operation. That's where the loan gets finalized, where the extended warranty gets pitched. The finance manager's job is to maximize the value of your deal to the dealership. That's not a criticism of individual people, it's a description of the system. And then there's the culture layer. Cars in America aren't just transportation. They are wrapped in identity, aspiration, and status in a way that is almost uniquely American. Car commercials don't show you amortization tables. They show you open roads and freedom and a version of yourself that is capable and successful and attractive. They associate the vehicle with an emotional state that you want to be in. And then they show you a monthly payment at the end that seems totally reasonable given how good you just felt for 30 seconds. Dave didn't buy a car, he bought the feeling. Section 7. How to actually calculate your number all right. We've done enough diagnosis. Let's talk about what to actually do with all of this. The first thing, the most important thing, is to calculate your own number. Step 1. Find your true purchase cost. Take the out-the-door price, everything included at signing, and write that number down. Step 2. Calculate your total loan cost. Take your monthly payment and multiply it by the total number of months in your loan term. Subtract your original loan principal. The difference is your total interest cost. Step 3. Find your current equity position. Go to Kelley Blue Book or CarMax and get a real offer. Subtract payoff from offer. If positive, you have equity. If negative, you're underwater. Step 4. Calculate your annual operating cost. Pull the last 12 months of insurance, registration, maintenance, and fuel. Add those 4 numbers together. Step 5. Add in your depreciation cost for the year. Look up what your car was worth 12 months ago versus today. Now add annual operating cost plus annual depreciation plus annual loan interest cost. That is your true annual cost of this vehicle, not the payment, the total. Let me run through a realistic example. Say you bought a 3-year-old mid-size SUV 18 months ago for $32,000. You put $2,000 down and financed $30,000 at 8% for 60 months. Your payment is around $610 a month. Total loan cost, $36,600. Total interest, $6,600. Current value, $24,000. Payoff, $26,000. You're underwater by $2,000. Annual operating costs, $2,000 insurance, $200 registration, $800 maintenance, $2,200 fuel. Total, $5,200. Annual depreciation, $3,000. Annual loan interest cost, approximately $2,000. Added up, true annual cost of this vehicle, $10,200. That's the number Dave found in the parking lot. You're underwater by $2,000. Annual operating costs, $2,000 insurance, $200 registration, $800 maintenance, $2,200 fuel. Total, $5,200. Annual depreciation, $3,000. Annual loan interest cost, approximately $2,000. Added up, true annual cost of this vehicle, $10,200. That's the number Dave found in the parking lot. So here is what informed looks like. If you're preparing to buy a vehicle, run the full 5-step calculation before you step onto any lot. Model the total cost of ownership for every vehicle you're considering, not just the monthly payment. Include depreciation, financing, insurance class, maintenance, and fuel economy. Make the decision with the real number in front of you. If you're in a stable car situation, Ask yourself honestly whether you're holding onto a vehicle longer than you need to or upgrading more often than makes financial sense. The average car in America is over 12 years old. The average American replaces their vehicle every 6 years. The people doing the math tend to be in the first group, not the second. And finally, think about what the difference could mean. Going from $12,000 per year in vehicle costs to $8,000 and directing that $4,000 toward a retirement account or index fund over 25 years at 8% produces approximately $300,000 in additional retirement assets. From one decision, made consistently, that's not dramatic, that's just math. If you're in a stable car situation, ask yourself honestly whether you're holding onto a vehicle longer than you need to or upgrading more often than makes financial sense. The people doing the math tend to hold longer. And finally, think about what the difference could mean. Going from $12,000 per year to $8,000 and directing that $4,000 toward an index fund over 25 years produces $300,000 in additional retirement assets. Dave knows his number now. He knows what his car costs him annually, not the payment, the whole number. He knows what that money could become over 20 years if it went somewhere else. He knows the monthly payment was a framing device, not a financial fact. He knows the loan structure was designed to benefit the lender first. He knows the system was optimized to prevent him from doing the exact math he sat in that parking lot doing. He's going to run out his current loan. He's not going to roll it over. He's not going to visit the dealership on a slow Sunday afternoon because there's nothing else to do and the new models look good. He's going to take the $250 a month he was loosely planning to put toward an upgrade and move it somewhere it can compound. Dave didn't escape the car trap this time, but he can see it now. He's going to run out his current loan. He's not going to roll it over. Dave didn't escape the car trap this time, but he can see it now. And seeing it clearly is the beginning of making different decisions. The kind of decisions that look very different 20 years later. That's what Dollar Blind is about. Not the flashy move, the clear picture. Hit like and subscribe.